Imagine receiving an inheritance of investments your loved one held for many years, like stocks or mutual funds. When it comes time to sell them, you might worry about a huge tax bill on all the gains they made over decades. But what if there was a way to significantly reduce, or even eliminate, that tax liability on those profits? This is where an important rule comes into play that can save beneficiaries a substantial amount of money. The stepped-up basis rule is a crucial tax provision that applies to assets inherited from a deceased person, including investments like stocks, bonds, and mutual funds. Essentially, when you inherit an investment, its cost basis is automatically adjusted, or quote-unquote stepped up, to its fair market value on the date of the original owner's death. This means that for tax purposes, your starting point for calculating gains or losses is not what the deceased person originally paid, but rather the asset's value at the time you inherited it. The primary reason this rule exists is to prevent what is known as quote-unquote double taxation. Without it, assets could be taxed first as part of the deceased estate and then again as capital gains when the beneficiary sells them. By stepping up the basis, the Internal Revenue Service, or IRS, aims to provide relief to beneficiaries. This adjustment effectively wipes out any capital gains that occurred during the original owner's lifetime, significantly reducing or even eliminating the capital gains tax you would owe if you sell the asset shortly after inheriting it. To take advantage of this rule, your first step is to accurately determine the fair market value of the inherited investments as of the date of the original owner's death. This often involves obtaining valuations from financial institutions or brokerage firms. You will then use this stepped-up value as your new cost basis. For instance, if your loved one bought shares for $100 and they were worth $1,000 when you inherited them, your new basis is $1,000. If you then sell them for $1,100, you only pay capital gains tax on that $100 increase, not the original $900 gain. This rule is particularly beneficial for long-held investments that have appreciated significantly over time, as it offers a fresh start for capital gains calculations. It applies to assets received through a will or living trust after death, but generally not to assets received as gifts while the original owner was still alive. Understanding the stepped-up basis rule empowers beneficiaries to make informed decisions about managing and potentially selling inherited investments, ensuring they retain more of their inheritance. Knowing about the stepped-up basis rule is like having an insider's guide to managing inherited wealth wisely. It means less money going to capital gains taxes and more remaining in your pocket to support your financial goals. By correctly establishing the new cost basis, you protect the value of your inheritance and simplify future financial planning for these assets.